In this video, we're going to be looking at Part E of SAICA First Board Exam that was written in January 2025. This question covers IFRS 2, so you need to have a very strong understanding of share-based payment. How do you see a cash circled as well as equity circled share-based payment? So that was the most important thing that you had to understand very well and very clearly in order to be successful in this question. Let's look at what the examiner wants from us. The examiner wants us to discuss any concerns that we may have about the draft journal entry process by the accountant. That relating to the share option scheme for the year ended 30 June 2024. We need to advise the accountant on the correct journal treatments or correct accounting treatments of the share option scheme. What they want us to do, they want to support our discussion with calculation. However, we're not required to provide a correcting journal entries. So what does that mean? We are going to give the accountant an advice as well as the calculation. However, we are not going to be processing any journal for the accountant. We do not need to discuss any matters relating to presentation and disclosure. So what does that mean? We are only worried about the recordings on the financial statements. However, when it comes to the disclosure as well as presentation, we should not discuss anything. And we are asked to ignore all forms of taxation. So it is very important when you read a required, you read it with understanding so that you make sure you don't find yourself answering things that you are not required to do. In that case, it will be you talking about the presentation and disclosure. You are not going to get any marks for doing that. However, you're going to waste the most valuable time in the exam. So what are we trying to do here? We're trying to make sure that when you're reading the required, you know exactly what you are supposed to do and what you're not supposed to do. In that ways, you are going to be able to finish your paper in the exam room. So now that we have read the required and we understand what we're supposed to do or what we're required to do, we are going to go back to the scenario and read the section that relates to the share-based payment. Once you have grasped all the information or all the information that is important for part E of the required, we'll then move to the scenario and see what the scenario has for us. Now let us go and check our scenario. In our scenario, the information about the share-based payment is sitting on part 5, where they talk about senior management incentive scheme. They're saying on 1 December 2023, TT granted 10,000 shares per senior manager for all the 16 senior managers of the company. And then the grant date share price is 6.50, or the exercise price will be 6.50, like 6.50. They are saying then this will vest 3 years later. The vesting date will be on 30 November 2026. And then there are two things attached to this. That the senior employee needs to be still employed and the share price should be trading at 10 Rand. That means the expectation is that all the 16 employees to be entitled to the share-based payment award, they need to be employed 3 years later, which will be 30 November 2026, and the share price needed to have increased by 3.50 Rand. Then what happened? So on grant dates, they did not expect any director would leave the employment, and their expectation was that the share price would trade at above 10 Rand, meaning to say they believe that both the market condition as well as service condition will be met when those shares actually vest to employees, which will be 30 November 2026. Then when we move down, they're saying on 30 June 2024, which is our first financial year end after the grant date, which took place on 1 December 2023, 2 of the 16 directors resigned and another senior manager medical boarded, right? Still working, however, medical boarded. And 1 more senior manager is expected to resign. So now when you see this information, you might think you need to remove the medical boarded one. The medical boarded one will still participate in the share option scheme. The only employees that aren't going to be participating are the one that resigned. But the one that medical boarded need to still be considered in our calculation of share option scheme. Then there is the following information that we are provided about the fair value. So on the grant date, which was 1 December 2023, the fair value considering market condition as well as market condition and fair and service condition is 4.50 and 4.50. And then year end, which is 30 June 2023, the share price of the fair value is 4.10, while on the other side, the fair value considering market condition as service condition is 3.98. So what do you know here that is important is the fact that the senior managers will receive shares, right? That means this is equity circled share-based payment. For equity circled share-based payment, that means that we do not change the share price. So the share price that will be used for our calculation throughout the 3 years vesting period needed to be the share price at grant date. What is the other thing that we know about the share price that we can use? The share price that we need to use, it is the share price that only consider market condition. Why is that so? Because the service condition is addressed by whether people resign or not resign. So now what does that mean for equity circle share-based payment? The share price that should be used is R4.50. Let us see what we have on the journal. So when we look at the journal that was processed by the accountant, or rather the drafts, because they said it's a draft, it's not processed, but it's what will be processed if you are happy with the information provided by accountant. So if we're looking here, they said interest expense, P&L. If we look at the interest expense, it's incorrect because this should be P&L employee benefit. So it should not be an interest expense, but this is an employee benefit that will go to P&L. So when you look here, you see, oh, obviously now I understand why I'm told to look at this journal and raise the concern. The first concern is that this interest expense is incorrect because I should be having share-based payment, P&L. Then I'm looking at the credit side. It says cash circle share-based payment liability, which is also incorrect because this should be equity reserve. Why am I saying it equity reserve? Because I am told that they will receive shares. If they receive shares, that simply means that it is equity circled share-based payment, meaning to say it is not a cash circled share-based payment because they are not saying they will gain on the share, they will receive cash for the shares that have appreciated in value. However, they are saying they will get shares, 10,000 shares, provided the savers as well as performance conditions are met. Now I see now I have two concerns. I have concern that the debit side is interest instead of being employee benefit. The second part is cash circled instead of being equity circled. And then I'm looking at the calculation that the accountant has used. If I'm looking at the calculation, the accountant said 12 times 10,000 times 3.98 times 12 over 36. So now I first need to ask myself, is this 12 correct? And how it was calculated. If I'm looking at this 12, it means that the accountant said 16 minus the 2 that have resigned, minus the medical boarded one, and minus more senior manager or one more senior manager expected to resign to get this 12. So now I can see the 12 is also incorrect. Why? Because she or he included medical boarded, which should not be included because this person will still participate in the share-based payment because it's still an employee of the organization. So the only employees that should not be considered in the calculation of this equity reserves is the 2 employees that resign plus 1 that is expected to leave. So those should be 13 and not 12. And then 10 is correct. And then we're going to look at the price they've used. It seems like the accountant used 3.98, which is the price at year end taking into account the market performance and the service condition. That is also incorrect. And why is it incorrect? Because for equity circled share-based payment, we do not change the share price. We hold the share price at grant dates for the entire direct direction of the vesting period. For that reason, then we know that this 3.98 is incorrect. And why 3.98 is also incorrect? Because the service condition is also considered in this price, which does not need to be considered. It's only the market condition that need to be considered, because the service condition will be considered by the expected number of shares that are expected to be granted to the employees. Then we're looking at 12. By using 12, it also incorrect, because during the year we have a total of from here to year of 7 months. So it's December plus 6 months of 2026, which give us 7. So that means here we should have 7 over 36 and not 12 over 36. And then what is saying here is saying recognizing share-based payments liability. Now that we've looked at what we have in the scenario, it is now the time that we go back and look at what we have in the solution. Now we're looking at the solution. So what the solution is saying the accountant recognized the liability. So that was incorrect, because we should have recognized the equity reserved. As I've stated, that this is not cash circled, but it's equity circled. That means we should not recognize liability. However, the equity reserve should be recognized. Why? Because this is circled in shares, therefore it is equity circled share-based payments. So this was very important for you to show the examiner that you understand IFRS 2. This shows the examiner that you really understand the difference between equity circled and share-based payment, as well as case circled share-based payment. And you could identify this as an equity circled share-based payment on the basis that the senior managers will receive shares as opposed to any share appreciation money that they would have received as opposite. And then when looking at the 3.980, as I've stated, that price was incorrect. The accountant should have used 450 and should not have used the share that take into account of board performance and service condition. And then if we move down, this is an equity circled, so we should not remeasure the option, meaning to say we're going to keep 450 throughout the vesting period of 3 years. And then what is the share price that should have been used? It's 450 throughout the vesting period. And then the service condition get adjusted through the number of options expected to be exercised. So why are we using market condition share price, not the market condition and service condition considered? It because the service condition will be adjusted through the number of options expected to be exercised. And then we're looking at number 6. The period used is incorrect. The accountant used 12 months instead of 7 months. Why is it 7 months? Because we count from 1 December 2023 until the year end, which is 30 June 2026. 2024. And then the journal entry adjusted for is incorrect. Number of 12, which we have already said. And then there are only 2 senior managers who left and 1 expected to also leave the employment or resign. Therefore, 3 should be used. However, the accountant used 4, meaning to say the medical boarded 1 was also considered. So we should not exclude the medical boarded 1. However, we should include the employees because it's still going to benefit in the share-based payment award. Now, how then we should have calculated this equity reserve? It should have been 16 minus 2 for the one already resigned minus 1 expected to resign. Then we multiply by the 10 number of shares that each senior manager will receive times 4.50, which is the price at grant date, taking into account only market performance condition. Why are we not taking into account the service condition? It is on the basis of the fact that it get adjusted by the expected number of shares expected to be granted to the employees. Then we multiply by 7 over 36. Why are we using 7? Because the grant date was 1 December 2026. If you count from 1 December 2023, then you count up until 30 June 2024, you get 7 months. Then the equity circled that we should have recognized at 113,750. Then now, by using the debit side to be interest is also incorrect because we should have share-based payment or employee benefit as a P&L. And then correct that interest expense by having employee benefit P&L, and then we debit that amount by 113,750. So what was critical thinking on this question? It's for you to show the understanding that this was not a case circle share-based payment. However, it was an equity circle share-based payment. So showing that distinction between equity and cash, it would have made you to be awarded an extra 1 mark. So this takes us to the end of this question. Thank you so much for listening up until this far. Please follow me on YouTube. My account is Economics199, as well as on TikTok at Economics199. We will then do the last part of this question, and then I will move to the other questions. Thank you. Bye.